Welcome back to the deep dive, where we really try to cut through the noise on complex financial stuff and pull out what you actually need to know.
And today, we're tackling Coinbase Global. Coin, it's fury. It's fascinating because it really does mirror the wild swings and the overall health of the whole crypto market.
Exactly. And we got a challenge from the listener. Can this super high growth, notoriously cyclical tech stock actually meet the really tough standards of deep value investing?
Right.
So we're bringing out the big guns financials, a Buffett-style checklist, DCF analysis, the works.
And it's crucial, right? Coin is all about these cycles, boom and bust. So we've got to look at this really strong Q3 2025 performance they just had, see what's driving it now, but then step back and use that disciplined value lens to figure out if this momentum is like sustainable long-term value or if it's just, riding the current crypto wave, market euphoria versus real value.
Okay, so let's unpack that Q3 report from 2025. The headlines definitely scream crypto's back. They smashed analyst expectations. A big recovery sign.
Oh, powerful is definitely the word. Total revenue hit, $1.9 billion? That's up 57% year over year. Huge.
57%.
But the real eye-opener is the leverage. Net income just exploded. $433 million. That's like almost 5 times what they made same time last year. A 477%.
That 177%.
Yeah.
On net income.
Wow.
And that leverage, that's why the EPS number, the earnings per share, came in so strong at $1.44.
Good.
Beat the consensus by nearly 40%.
Yeah.
So clearly, when the crypto market turns positive, Coinbase just starts printing cash.
It really does. And where that cash comes from, it just confirms its high beta nature. The main driver is still transaction revenue, grew 82.8% year over year, hit $1 billion.
$1 billion just from transactions.
Fueled by trading volume, right? Total trading volume jumped almost 60% year over year to $295 billion. So the takeaway is pretty simple. Coin is still fundamentally hooked to, crypto hype and trading activity.
Okay, but we got to push back on that a bit, right?
Yeah.
Looking deeper, that growth wasn't all organic, was it? Especially on the institutional side.
That's a really important point. Institutional trading volume was up nicely quarter over quarter, sure. But $52 million of that institutional revenue actually came from the Deribit acquisition.
Ah, the acquisition.
Which only closed mid-quarter, like August 14th. So if you kind of mentally pull that out, the organic growth in their core institutional trading business, it was, quite a bit more modest than the big headline number suggests.
So is that management kind of trying to paper over slower core growth? Or is this acquisition just, necessary diversification?
I lean towards necessary execution, actually. Deribit gives them access to the derivatives market that's vital for them internationally and for long-term stability.
Okay.
So it bumps the numbers short-term, but strategically it shows they're trying to expand beyond just U.S. spot trading. That seems smart.
All right, let's talk about their big strategic push for stability. Subscription and services. That's supposed to be the anchor, right? The less volatile part.
And, this is where you see the tension. That segment is strategic. It grew nicely, up to $747 million, a 34% jump year over year, mostly driven by things like stablecoin balances, USDC, where they earn yield, over $15 billion in USDC they mentioned.
Okay, 34% growth. That sounds pretty good.
It is, but here's the catch. The sequential growth, quarter over quarter, for subscription and services, only 14%. Compare that to the transaction side, which grew 37% quarter over quarter. So the stable stuff grew less than half as fast as the volatile stuff in the recent quarter.
So despite the strategy to build stability, the core volatile nature still dominates when things get hot. The transactional boom just swamps the steadier income, reinforces that high beta thing.
Exactly. They're still, at their core, a leveraged bet on crypto market volumes.
Okay, so given that volatility, they absolutely need strong competitive advantages. What really makes Coin more than just another trading platform? What's the durable moat here?
Well, it's layered, I think. The first layer is intangible. It's brand and trust. In a space littered with collapses, hacks, FTX, Coinbase is often seen as the safe, reliable way in for regular investors. That trust, it's incredibly valuable.
The trust is huge, definitely. But maybe the strongest advantage, especially in the U.S., has got to be the regulatory piece, right?
Yeah.
Compliance.
That is, I think, the single biggest factor. Their whole compliance-first approach, it's expensive, but it acts as this massive wall, a barrier to entry. It makes them, as they say, the indispensable partner for regulated financial institutions. I mean, look at BlackRock picking Coinbase Prime. That's the ultimate proof point for that regulatory moat.
So brand gets the retail folks, compliance gets the big institutions. What else? What about the ecosystem itself? Does they lock users in effectively?
They're definitely trying to build those switching costs higher,
Yeah.
integrating things like Coinbase Prime, their wallet, the base layer 2 network. It all creates stickiness. And crucially, they're now taking on the decentralized exchanges, the DEX, directly. They integrated DEX liquidity. So instead of just trading like 300 assets, users can now access over 40,000 assets right there on Coinbase.
40,000. Wow. So you don't need to leave their platform.
Exactly. Keep users inside the tent. It's a smart defensive move.
Okay, great defense. But let's talk about the friction that creates. If compliance is so expensive, is that regulatory moat really an advantage, or is it more like a permanent tax dragging on their competitiveness?
That is the absolute core tension. The biggest single long-term risk for Coinbase, it's political and regulatory risk right here in the U.S.
Specifically.
The ongoing fight over asset classification. Are these tokens commodities or are they securities? That's like an existential question for them. If the SEC comes down hard, forces mass delistings, imposes huge fines, that compliance advantage suddenly looks like a massive liability.
And that same regulatory moat, it creates this weird situation, right? An unlevel competitive landscape.
It totally does. Coinbase is spending a fortune on lawyers, compliance, KYC, playing by the U.S. rules. Meanwhile, you've got these offshore exchanges, less regulated, innovating faster, listing more stuff, even attracting U.S. customers sometimes with fewer hurdles.
So Coinbase's compliance burden makes them slower, more expensive.
Puts them at a structural disadvantage against those international players who just don't have that same regulatory tax. They're slower precisely because they're trying to be safer and compliant in their main market. It's a real balancing act.
All right, time for the big test. Let's take this, traditional disciplined value framework, the kind built for steady, predictable companies, and apply it to this volatile tech beast. What happens when Goryam meets the Buffett checklist?
Yeah, it's kind of a classic square peg, round hole situation. KIN basically fails most of the criteria that focus on predictability and conservative valuation. It's really the antithesis of that stable, predictable, great company that traditional value investors look for.
Okay, let's break it down. Valuation multiples first. You mentioned a PE ratio of 33.20-year TPM and a price to book of 5.77 TTM. Why did those numbers immediately fail a classic value screen?
Well, a traditional value investor, think Ben Graham or early Buffett, wants a low PE, maybe under 15 or 20, definitely not 33. And price to book, ideally close to 1, meaning you're buying assets near their recorded value.
Right.
Koyan's high multiples scream future growth expectations. The market is pricing in massive expansion, not buying existing value cheaply. It's priced like a growth stock, plain and simple.
And what about consistency? That's huge for value investors. Predictable earnings, predictable free cash flow.
Yeah, another clear fail, purely because of the cycles. You look back at 2022, the crypto winter. Massive negative EPS, negative free cash flow. The checklist demands a decade of consistently positive, hopefully growing earnings and cash flow. Koyan just can't show that kind of stability across market cycles. It's impossible given the business.
Okay, so the stability metrics are a bust. But where did the underlying quality of the business manage to shine through on the checklist?
It passed really strongly on profitability and financial safety. The gross margin is phenomenal, 85.20% TTM. That's typical of a super scalable software platform, very high leverage potential there. Not many companies have margins like that.
85% gross margin.
Okay.
And the balance sheet, did they manage okay through the downturn?
Oh yeah, fundamentally sound financially. Their current ratio is 2.40 TTM, which means they have plenty of liquid assets to cover near-term debts. Very strong.
Okay.
And the interest coverage ratio is almost 39. 38.76, meaning earnings cover interest payments many, many times over. Low default risk. The company itself is solid. It's the income stream that's unpredictable.
So this really highlights the tension, doesn't it? Fails on stability, but has this incredible high-margin engine underneath.
Yeah.
How do we even categorize a stock like this?
Well, it forces you to maybe shift your framework a bit. Since the potential for explosive earnings growth is so obvious, the traditional Buffett metrics just don't capture the whole picture. The data actually suggests it fits much better into the growth at a reasonable price, or GARP framework. Peter Lynch was famous for this style.
GARP.
Yeah.
Okay, what specifically makes GARP seem like a better fit here?
GARP investors often look at the PEG ratio. That's the PE ratio divided by the expected earnings growth rate. If that PEG ratio is below 1, it suggests the market maybe hasn't fully priced in the future growth yet.
And Coin's PEG.
It's remarkably low, comes in at 0.39 TTM. So from a GARP perspective, you're buying incredible potential leverage and growth, possibly at a reasonable price relative to that growth, even if you have to accept the lack of stability. It's a trade-off, but one that fits a specific investment style.
Okay, let's shift from the metrics to the people. Management signals. Brian Armstrong, the founder, still holds like 10% of the company, right? That's huge alignment.
Massive alignment. And it shapes the culture. It's
Yeah.
very founder-led, very focused. Do you remember that controversial AI ultimatum they issued? All about efficiency, pushing technology forward.
Right.
That intensity, plus Armstrong's huge personal stake, means they're likely focused on long-term execution. Building out things like the base layer 2 network, even if it doesn't pay off immediately. They're thinking about the next cycle, not just the next quarter's earnings.
And we see this huge split in the investment world over Coin, don't we? It's like a battleground stock.
Absolutely. You've got Cathie Wood's ARK Invest on one side, actively buying Coin. They see it as core infrastructure for disruptive finance. Essential.
The ultimate growth play.
Right. And on the other side, you have the icon of value investing, Warren Buffett, famously calling Bitcoin rat poison squared and avoiding Coin itself.
But there's a little nuance there with Buffett too, isn't there? An indirect signal, maybe?
Yeah, it's subtle, but interesting. Berkshire Hathaway, Buffett's company, doesn't own Coin, obviously, but they did invest over $1 billion in new holdings.
The Brazilian fintech bank.
Yeah.
Exactly, which is known to be very crypto-friendly, so it kind of suggests this pick-and-shovel acceptance. Maybe you don't bet on the gold rush itself, the volatile asset, but you recognize that the companies selling the picks and shovels, the infrastructure, have a viable business.
Interesting angle. Now, maybe the strongest signal management has sent, especially the value-oriented folks, that massive buyback program.
The $2 billion share and debt buyback program, yeah, that's a really significant signal. It's a classic sign of a company reaching a certain financial maturity.
What's the message?
Management is basically telling the market, we think our own stock and debt are undervalued right now. They believe it's trading below intrinsic value. It's a huge vote of confidence in their own long-term cash generation ability, even if that cash arrives in, big cyclical waves. Commitment to shareholder value.
Okay, but despite that confidence, the ultimate valuation is still incredibly tricky. The discounted cash flow analysis, the DCF, really shows that uncertainty, right? The range is just enormous.
It is. The spread is massive, and that's maybe the most critical takeaway from any valuation attempt here. We use a pretty high discount rate, 12.5%. to account for all the risk.
12.5%, okay.
But even then, the assumptions you have to make about future crypto market cycles, they completely dominate the outcome. The model is just extremely sensitive.
So give us the range. What does the pessimistic view look like?
Okay, the conservative case. This basically models another crypto winter, like a 2022 style crash hitting almost immediately. Sharp drop in trading volume, fee compression. That scenario gets you an intrinsic value of around $125.40 per share.
Okay, $125. And what about a more, say, reasonable outlook? The current cycle kind of continues but cools off eventually.
That's the nominal case. It models a solid multi-year cycle, strong but not like completely crazy forever. That one lands at $310.88 per share.
310. Quite a jump. And the bull case, hypergrowth continues.
Yeah, the optimistic case. Here we assume sustained high growth, maybe fueled by more institutional adoption, new products really taking off. That pushes the value up to $545.75 per share.
Wow. From $125 to over $545. That spread just perfectly illustrates the gamble, doesn't it? Success really hinges on getting the big picture crypto cycle right.
Totally.
So given that huge uncertainty, how can we, as learners trying to follow this, even get a handle on whether we're closer to the nominal case or the optimistic one? It feels like you need to constantly monitor the overall market temperature.
That is absolutely key. Because Coin is so leveraged to the whole market, you really do need those external signals. Smart investors often use tools that track broader economic cycles or market sentiment indicators to get a feel for where things stand.
Right. Speaking of which, for you, our listener, if you are trying to track that total market temperature in real time, which is super relevant for a stock like Coin, we actually highly recommend checking out an iOS app we developed. It's called Buffett Indicator. You can search for it and download it from the Apple App Store. It's designed to give you a quick read on the broader market cycle, which, as we've discussed, is pretty essential context for analyzing these high beta names. Hashtag tag outro.
Okay, so let's try to tie this all together. We've got the explosive growth, but it's cyclical. We have the regulatory moat, but it's also a cost burden. It fails the traditional value test for stability, but aces on margins, and the DCF. All over the map.
So what's the single most important takeaway for someone trying to understand Coin-On?
I think it's this. Coinbase is the absolute textbook definition of a high beta investment. Expect dramatic boom and bust cycles to continue. Its long-term success probably hinges less on just managing costs, and they seem pretty disciplined there, and much more on navigating that incredibly tricky regulatory balancing act.
Right.
That compliance strategy is their moat in the U.S., yes, but it's also what potentially slows them down compared to faster, less regulated offshore competitors. Winning that balancing act is the core challenge, long-term.
Which brings us right back to that deep value tension. The traditional checklist struggles, it just doesn't fit well. But if value is ultimately about future cash flow potential, and that optimistic DCF case shows massive potential, maybe the question we should be asking is different. Well, is the extreme cyclicality of crypto just a new type of risk? A risk that value investors maybe need to learn how to analyze and incorporate, rather than just automatically rejecting stocks like Coin because they don't fit the old stability mold. That's the provocative thought I'd leave everyone with.
Interesting way to frame it. And remember, folks, all the analysis we discussed today is based on public information. It's purely for educational purposes. It is definitely not investment advice.
Absolutely. Please do your own homework, your own due diligence before making any investment decisions.
And if you enjoyed this and want to hear more deep dives like it, find us and subscribe on Apple Podcasts or Spotify. Just search for Deep Value Investing.
We'll catch you next time for another deep dive.